Welcome to today's webinar featuring Ben Inker, hosted by CFA Society Chicago's Distinguished Speaker Series Advisory Group. Information on upcoming events can be found on the Society's website at www.cfachicago.org. All mics for attendees will automatically be muted during the event. If you'd like to ask a question, please use the Q&A feature. This event is being recorded. Today's discussion will be moderated by Jeremy Here, Senior Portfolio Manager for the Strategy Group at the University of Chicago's Office of Investments, and a member of CFA Society Chicago's Board of Directors. Joining Jeremy for today's discussion is Ben Inker, Head of GMO's Asset Allocation Team, and a member of the GMO Board of Directors. Ben joined GMO in 1992 and has served as an analyst for the quantitative equity and asset allocation teams, as a portfolio manager of several equity and asset allocation portfolios, as co-head of international quant equities, and as CIO of quantitative developed equities. I will now turn it over to our moderator, Jeremy Here.
All right. Hey, Ben, thanks for joining us today. We appreciate it very much. The CFA Society always likes to get interesting people on these. I think we'll just jump right in. Can you start off by talking a little bit about the process at GMO, the 7-year forecast, how your flagship portfolios work, and so on?
Yeah, so at GMO, we try to start out very much from a first principles idea of any kind of investment that we're going to try to make or we're going to try to come up with a forecast for. The first question is, what kind of risks do we think you're taking in buying that asset or performing that activity? And what kind of a return is a fair compensation for that asset or activity? And then that fair return is going to, in turn, drive our estimate of fair value. So fair value is a valuation level at which the cash flows associated with that asset or activity would suffice to give you a return which is fair for the risk you're taking. And what we do in our asset class forecast is we look at the current price of that asset relative to that fair price. Generally speaking, although this is a slight oversimplification, assume you'll get 1/7 of the way back each year, and say, what return are we going to get if we move 1/7 of the way back each year? And that return will come from both the cash flows and growth associated with that asset that you should achieve over that year, plus or minus a gain or loss from valuations reverting towards that fair value. So most of the volatility to those forecasts are driven by changing valuations. But most of the return to most assets over time should always be coming from the cash flows that that asset embodies.
Okay, and so you think that each of the components of the return are you're not making any assumption on how quickly they're going to go back. You just assume it's 7 years. It's all back kind of linearly because you don't know whether it's going to revert in a year or in 7 years, pretty much. Just kind of.
Yeah, I mean, there are certain things that we have evidence tend to regress more quickly, kind of styles relative to broad markets. There's evidence that that goes more quickly. If you look at, say, currencies, the evidence is that while mean reversion occurs, it happens more slowly. So it's not universally 1/7 of the way for each asset, but the basic idea is sooner or later things have to revert to fair value. So that reversion will create gains or losses, and then we'll also have, the return associated with the cash flows that it's generating along the way.
Okay, and so if that's the case, then how do you think about regime change or changing? It has to revert to a fair value, but what if the world changes in the interim?
Yeah, I mean, there's a couple of things that can happen. One would be the fair return to an asset or activity could change. Now, that could change because its riskiness has changed, and therefore, let's say it's a lower risk activity than it used to be, so the required return should come down. Another thing that is absolutely very much top of mind at the moment is the fact that it's easier when thinking about an asset to think about how much extra return I should be getting paid for taking the risk associated with it. If we think about equities, it's easier to say equities should give a materially higher expected return than bonds or cash because the cash flows are riskier and those risks are more correlated to other things that are generally bad for investors. But it's much harder if we're starting from, let's say, the short-term risk-free rate to declare, the rate of return on cash must be X over time. And what we've seen, certainly over the last 10 or 15 years, is this recognition that the rate of return on cash has been becoming lower and lower. And there is the question of how low can it remain in the long run? The lower it is, the higher the allowable valuations are for other assets, because it does lower the required return, right? If cash is going to deliver, I don't know, if cash delivers, let's say, inflation -1 over the next 100 years, stocks should not deliver the 6% real that they have over the last 100 years. That would be way too big an equity risk premium. So in that world, maybe equities should deliver only 3% real. Now, the slightly tricky thing about that, and particularly when you think of trying to forecast stocks or indeed cash and bonds, is at some level, we truly know what the market's future predictions are about future cash rates. Those are embodied in long-term interest rates. The other thing we know is the market has done a horrible job of estimating future cash rates. So I can say, yes, the market truly believes that cash rates are going to be very low forever. I can't say, well, the market believes that, and therefore we should all have high confidence that the market is right, because it has been more or less continually wrong in those expectations over time.
Right. Now, you guys have written about that in some detail. Fire and ice, they were called at one point. What are you guys calling these scenarios? It's 2 scenarios now. What are you calling them now?
Yeah, so we called them purgatory and hell.
Purgatory and hell, right.
Calling them purgatory and hell, less because we were offending people. I think we probably were offending some people, but more because people were just continually confused by the fact that the forecasts in hell were almost always higher than the forecasts in purgatory. And that just did not seem to fit with people's expectations of purgatory and hell. So we now call them mean reversion and partial mean reversion, which honestly I've never loved, because it's not so much partial mean reversion, it is mean reversion to a different mean. But the partial mean reversion scenario is one in which real interest rates have permanently fallen and will never go back up to the rates we got used to in the post-World War II era. Okay, and so which is your base case for kind of what you're doing in your flagship portfolios? Yeah, they kind of both are. We view them both as likely enough scenarios that we actually do 2 things. When building the portfolio, we do it based on expected returns, which are kind of a weighted average of the scenarios we consider plausible. But even beyond that, we also want to take a look at the portfolio and make sure that if either of these scenarios turns out to be true, we win. We don't want to be in a situation where, because we've got a 62.5% weight on, the full mean reversion and a 37.5% weight, I guess that's what's left, on partial mean reversion. If partial mean reversion happens, we're running a portfolio that we think is going to lose to its benchmark. So we're explicitly trying to build a portfolio that can be robust to both scenarios. Okay,
so that all makes sense to me anyway. Can you So can you talk a little bit about how you turn these forecasts into positions in, say, benchmark free, or pick a flagship that you like?
Yeah. So our benchmark free portfolio is an unconstrained portfolio that's trying to deliver 5% real in the long run, and doesn't really care about traditional benchmarks. So in that portfolio, we're making use of our expected returns, as well as kind of the aspects that don't necessarily fit into that expected return framework in terms of currently available alpha from different kinds of activities that a 7-year forecast really wouldn't make sense. But what we're trying to do is put together a portfolio that makes a lot of sense given those forecasts. That is not necessarily kind of absolutely optimal, because we do care about robustness here, but where the amount of risk we're taking is commensurate with how much we think you are getting paid for taking risk. We want to take more risk when you're getting paid a lot for taking risk, and lower our risk when you're not getting paid that much. And then once we've decided how much we want to have in risky assets, it's a question of there's kind of this tiering or this waterfall, right? We determine which is our favorite risky asset, and we want to put the first dollar of risk assets in there. And then depending on how much better that best asset is than the next best asset, that's going to determine how much concentration risk we're prepared to have in that asset before we move down to the next one and the next one and the next one. The nice thing about a strategy like this is, since we don't have to care about the benchmark, we're not owning anything for fear that it might go up, despite the fact that we don't really like it. It's really a question of how much overall risk do we want to take, how much concentration risk are we willing to take, and those kind of basic questions are all driven by how much am I getting paid for that kind of risk.
That seems like a great place to segue into a question that you guys talk about career risk a lot, and Jeremy wrote about it in the latest piece, and you and I talked about it at some length. Could you talk a little bit about career risk as it applies to somebody sitting on my side of the table, and then what it means to you guys, since I think that career risk would apply to you guys as well?
Oh, absolutely. Career risk applies everywhere where you have an agency issue, right? I am an agent on behalf of my clients. You are an agent on behalf of kind of the broader organization. You are answerable to somebody.
Sure.
And whenever you are answerable to someone else, it is important for you to understand how they're going to be judging you, and whether you're doing a good job or not. And the problem is there is some difference between the way you would naturally act if you didn't have that person looking over your shoulder determining how they're going to think you're doing a good job or a bad job, than if they are. So, for example, in kind of the world of university endowments, the obvious thing you're getting measured against is your peer group. Anytime you are choosing to look different than your peer group, you're taking career risk. Now, some career risk is, of course, necessary in order to have any shot of outperforming. Part of your job is to be better than your peers. But the question of how much risk are you prepared to take to be worse than your peers, that's where the career risk comes in. And it is a basic kind of reality of the investment business that once you have a job or once you have a mandate, the outperforming is great, but you're probably not going to get fired for having similar performance to the peers. You are going to get fired when you have differential and bad performance. So career risk suggests never look very different from your peer group or your benchmark or whatever it is you're going to be measured against. And the difficulty is that really does mean you will find yourself in a position of holding assets or performing activities that you think are a bad idea because you are afraid what will happen if they do well anyway. So just to, let's say, your peers in general have, well, your peers probably don't, but let's say they had 30% in the S&P 500 and you don't like the S&P 500 as we don't today. You can say, I think this is a horrible investment. It's very expensive relative to history. It looks like it's in a bubble, but that doesn't mean it can't go up. And I don't want to have too much tracking error against my peer group. So they're at 30%. Maybe if I'm at 26, I'm doing the right thing. It's not what you do for your money, but it is what you do for your professional portfolio, because to move to where you would with your money is taking too much career risk.
Okay, and then turning that around on GMO, of course, right? One could say that you guys have a bit of career risk. Like you can't really change gears very much, right? Because if you do, then that kind of people would lose conviction. It would be kind of tough from a business standpoint to do, right? So talk about that part of it a little bit.
Yeah, so there's a couple of layers here. One is once you have generated a kind of a known way of investing, changing from that creates risk, right? People hired you because they thought, oh yeah, you guys invest this way. If you change your mind and start investing in a different way, you have to make sure to be communicating that very well with them. Some of them are going to say, well, I hired you because I wanted you to invest this way and you're no longer investing this way, so I don't want you to. What is honestly more likely to happen is you change the way you're investing, the clients say, huh, that's interesting. I'm not going to fire you now, but I'm going to watch you like a hawk. And if you make that change and it doesn't work out well in the near term, I'm going to yank you. Now, the other two-sided kind of career risk we have, at least in asset allocation, is we're kind of one of the things we have made our names on is the people who are willing to take career risk in the spirit of doing what we think is right. So as long as we're being clear with the clients what we think, let's take the case where our clients have a benchmark which is 30% in the S&P, and we say we don't like the S&P. If we were to have 26% in the S&P, well, we're controlling our tracking error and controlling our career risk in that sense. But the clients would say, well, I hired you because I thought you guys were willing to make bets. And a 4-point bet ain't a big enough bet. So, there is career risk associated with, well, as soon as you have a career, right? As soon as you are a professional money manager is by definition someone who is managing money that's not theirs. So your idea of what risk is immediately changes. The biggest risk you have as a professional is not losing money, it is losing your job. And everybody has a slightly different set of calculations as to what are the likely ways and reasons they will lose their job. And there will almost always, for almost all of us, be a time where we're in an uncomfortable position because that calculation pushes against some other reasonably strongly held views about the right way to invest.
Okay, no, that's great. Let's move on to the the 7-year forecasts and kind of how they've worked over time. I think that kind of segues nicely from here. So that would be one way that someone might wonder whether the way you guys think about things really works, right? So the 7-year asset class forecast, you guys have been publishing them since the 90s, right?
Yeah, we started in 94, 95. So the good news is we have a lot of completed forecasts. And on average, there has been a significant amount of efficacy to those forecasts. They haven't been perfect by any means. There's a couple of notable ways in which we have been imperfect. One is we have systematically tended to under forecast. So our average forecast has been about 2.5 points worse than what actually transpired. The other is we have tended to somewhat overemphasize the differences. So the slope of our forecasts to actual returns has been about 0.8. So if it was perfectly calibrated, it would be 1. If there was no validity to it, it would be 0. We're closer to the 1 than the 0. So they've worked on average. The bad news is that hides the fact that we've had some 7-year periods where things have worked out exactly, not exactly, but more opposite to our starting views than not. The last 7 years has been one of those, and that's painful. But kind of some of the tricky problems of the asset allocation business is that pain has also set up what we view as some really extreme opportunities, which actually gives us more confidence going forward. The disconnect, however, is it is not natural for people to think, oh, this has been wrong, and therefore it is more likely to be right going forward, as opposed to, well, it's been wrong, so this whole framework should be ripped up and one should start anew.
No, it's true, right? You're from the classic value investors of our time, right? Cliff Asmus and so on. They're basically the same argument. That's actually a really good segue to my next question, which is, what are you excited about now?
Well, the thing I'm most excited about right now is the prospects for value investing. First and foremost, value investing as a stock selection technique. The reason why we're excited is because the spread between value and growth has gotten to one of the historic all-time wides. We're not quite as wide as we were at the peak of the internet bubble 20 years ago, but far wider than anything else, and we're as wide as we were in kind of late 99 or late 2000, just a couple of months off of the peak. So we think the opportunities for value investors are really good. We also think the opportunities associated with, frankly, avoiding US stocks and moving into the rest of the world are really good because the valuations are just a lot lower. So I'm very excited about the opportunity to kind of outflank a traditional portfolio. The bad news is we've had kind of a rally in everything. Valuations across the board generally look pretty expensive relative to history. Bonds obviously have a very low expected return to them. I mean, I think it's more or less impossible not to believe that. Stocks in general, we believe, have a low return associated with them, and real estate and infrastructure and the other things you can invest in likewise. So the opportunity to make absolute money by buying traditional assets is not very good, but we think the opportunity to differentiate yourself by buying the stuff that is relatively cheaper is very good. And we think the opportunity in value relative to growth is the second best for the last 100 years.
Okay, so in your flagship portfolios, what kind of expected return do you have for those? Or what are you thinking?
Yeah, so right now we're running a pretty aggressive portfolio. It's not really aggressive in the sense of having lots and lots of money in stocks. We've only got about 30% of our portfolio in stocks. it's very concentrated in the stocks we think are cheap today, emerging markets value and Japanese value. But we've got the kind of the other 70% is not in traditional fixed income. It's in alternatives. And the single biggest piece of that, we've got a 20% allocation to a strategy we call equity dislocation, which is explicitly a long value, short growth, long short portfolio, which is, to our minds, got the highest expected return of anything we know how one can do, given today's environment.
Okay. Can you talk a little bit? There's been some interesting developments in the markets lately. Talk about SPACs a little bit. Well, don't worry, we'll get to the other stuff.
Yeah, I mean, look, the last year has been an utterly extraordinary year. I think in retrospect, it will be one of those times that we are talking about to our grandchildren. Truly amazing things have happened. And the SPACs are just a fascinating innovation. It's a kind of a classic Wall Street innovation. It is very well designed to make money for a lot of the people involved in creating them and investing in them. The bad news is they're not very well designed to make money for the people who wind up investing in the companies that they take public. And historically, the returns to SPACs, once they have had their merger, have been pretty terrible, even worse than the average IPO, which over time has not been great. This year has been truly, I mean, to say this has been the biggest year of SPAC activity is, a crime of understatement, right? I think there have been more SPACs raised and more SPAC companies going public this year than in the entire history up until now. So this has been an explosion of activity. People will wind up regretting a fair bit here. But you understand, right? This is a wonderful thing for the sponsor because the sponsor gets 20% free equity in the enterprise that they merge with. It works out very well for the people who fund it originally, in general, the hedge funds, because they invest in. They have the option to take their money out when the merger happens. They often do that. They're effectively supplying a bridge loan at very low risk to these entities, and then they get to keep these warrants, which feel to them like free money in case things go up. They tend to be viewed by the company that they're merging with as a good deal because they get to go public without having to have all of the kinds of regulatory issues and disclosure that they would have to do in a traditional IPO process. And they certainly allow you to go public more quickly. And if the world is suddenly enamored with all things electric vehicles or autonomous driving, the one thing you want to do is get to market as quickly as you possibly can. And today, it's interesting, they're also very much in demand by the venture capital funders of these companies who are in this situation. They've got these companies, but it's harder to have IPOs. It's suddenly harder to sell to the tech giants who were the buyers of a lot of these venture-backed companies because of antitrust concerns. They need to find a way to go public, and this allows you to do it pretty quickly, and sometimes allows you to do it without as long a lockup as you'd have on a traditional IPO. But again, the people who are likely to be left holding the bag are the possibly credulous investors who bought in at the IPO or soon after.
All right, just a couple more things, and then we've already got some questions on the board here. But since we're talking about people holding the bag, I just wanted to ask you real quick about GameStop. It's been a pretty fascinating couple of weeks in the markets, to say the least.
Yeah, it really is amazing. And this is, the war stories people have about the internet bubble and the extraordinary things that happened, then they got nothing on GameStop. One of the profound differences between what's going on with GameStop right now and the vast majority of what happened in the internet bubble. In the internet bubble, you had people who maybe believed wrongly that it made sense to create a business associated, that involves free shipping of pet food or something like that. But they legitimately believed that these companies were going to change the world. In the case of GameStop, and there's something almost hypnotic about reading the subreddit associated with this. A lot of them freely admit the fundamentals of this company do not matter at all, and that damn well better be true because the fundamentals of the company are pretty horrible. But this is absolutely a coordinated bull raid in a way that, now I am not a securities lawyer, but I would generally have thought that this kind of coordination is not legal. Now, I'm not a lawyer. I don't know. Maybe this is somehow legal, but it is the kind of behavior that you remember reading about in kind of the late 20s, and they created securities law around stopping. But the other weird thing as you read about this is, again, there's something different about this than there would be about Tesla. The Tesla believers, they just say, hey, you don't understand how wonderful this company is. And sure, it's not going to sell 10 million cars until 2030. And the companies that sell 10 million cars today are worth, I don't know, 50 to 80 billion dollars, and Tesla's trading at 800 billion dollars. But it is really about belief in the company. Here, it's about owning the shorts in a way that the alt-right would talk about owning the libs. I mean, it's this weird, very, very social construct, but this strangely us versus them. I mean, not just a you don't get it, but I am out to try to destroy you through my speculation. And of course it will end badly, right? I mean, it has to end badly. It doesn't have to end badly for GameStop. The one thing that, if I could give any advice to GameStop, is, my God, raise money through equity.
Exactly.
I don't care what you do with it. Have it sit in cash. This is wonderfully accretive. But of course, it has to end badly for anybody who is effectively owning the stock at $100 a share or wherever it is, this minute, because it jumps around. But this is a kind of activity. I mean, certainly I can never recall seeing in my 30 years in the markets, and I'm not sure it's ever happened before.
Yeah, it's, the 20s, 30s was exactly the other time when that kind of stuff happened, for sure. Right. It's a great analogy, actually. Okay, great. Thanks for your thoughts on that. That was the last thing that I think we really needed to cover, since it's timely. I'm going to hit on a few of these questions. We have Tom. Tom's got a couple good questions here. The value indices are dominated by energy and financial stocks. You have a global energy glut. Green energy tech is beginning to reach parity with fossil fuels. So fossil fuel demand is not going to grow much at all. Financial stocks are unlikely to see a positively slowed yield curve. So, with the Fed being accommodative, so why would energy or financials even begin to outperform?
Yeah, so I think it's important to differentiate value, the Platonic idea, from value, the embodiment in some particular index. And the indices have a bunch of problems. One of them is that, with regard to, say, the financials, to me, the problem is not so much that the financials are never going to make any money because you're not going to have a positively sloped yield curve. If you look at it, a lot of the banks are actually doing pretty well these days. And unlike the financial crisis, the COVID crisis was not a crisis of the financial system. It was not a crisis of bad debts. So I think whereas the financials in the GFC were uniquely positioned for pain, today we've got a situation that might be challenging to the financials. But to me, the biggest problem with the value indexes is that financials are always big constituents of the value index, right? Today, financials in general are trading at a significantly larger discount to the market than they normally do. To me, that says, okay, they're cheap today. So I'm actually, in general, kind of bullish on the financials. But the problem with the index is whether the financials were cheap relative to their history or expensive relative to their history, they'd be a big part of the index. Actually, if they were expensive relative to their history, they'd be an even bigger piece of the index. Right. One of the things that's true today is energy is not a big piece of the value index because energy's market cap has so shrunk. It's not a big piece of anything anymore. But I would say you don't have to bet on financials to believe that value is going to work. You don't have to bet on energy to believe that value is going to work. You could do your value investing on a purely sector or industry neutral basis, and spreads are near the all-time widest they've ever been. I actually think that that is potentially a dangerous way to do things. I think it does make sense to bet on sectors that are cheap relative to their history. Because I think that the width of the sectors today is really quite considerable. But I would not want to allow a bet on value to just come down to either a bet in favor of financials or a bet against IT or kind of any single factor which is related to value, but is not kind of the platonic value itself. The way we think about this is, yeah, IT has done awfully well. It's trading expensive relative to its history. I think you want to be somewhat net short IT, but value versus growth in the Russell 1000 would be probably, 28 or 29% net short IT. That's an awfully big bet. So, maybe we're 6 points net short IT, and we don't want to be 25 points net long financials, but maybe today it's okay to be 10 points net long financials. So I think there's a variety of ways you can deal with the problem of any individual factor or sector that you are very concerned about that is otherwise aligned with value, getting rid of that risk. Our way of thinking about it is rather to say, we want to make sure that no single factor bet or sector bet we have is going to dominate the return here. But we want to have those bets that are really getting to the heart of the dislocations in the market today.
Okay, yeah, that makes sense. I've got a couple of questions here that are kind of related, I think. $5 trillion of cash on the sidelines and a Federal Reserve that is committed to funding deficit spending through quantitative easing. Wouldn't it be wise to stick with long duration assets, which means you should stick with growth stocks? Value has limited growth opportunities. And we have another one about unprecedented intervention by central banks. They reckon it could push off when things revert. So how does that impact your forecast? Those seem to me. Do you want to talk a little bit about the current situation we're in and how that affects your way of thinking?
Yeah. So the one thing is, you don't have to resort to questions of flows and potential flows to question whether valuations in general have to revert back to historical averages, right? If it is possible for interest rates to stay at these kinds of levels, then the overall valuation of stocks around the world isn't crazy. Maybe the US is a little bit more on the overvalued side, and EM and Japan are a little bit on the undervalued side, but it's not crazy. I would argue, no matter what you think about the overall valuation of the S&P, GameStop is crazy. I would argue Tesla is crazy. I mean, there is crazy stuff going on in the market today, irrespective of whether the overall level of the market has hit a crazy level. And from my perspective, I don't view that we are taking this giant bet that the market is going to fall. It is that I'm not hugely comfortable taking a bet that the market is going to continue to rise, which is the way you make money from these long duration assets. You need them to rise up in valuation. The other thing I think people should recognize and be a little bit cautious about with regard to growth stocks and their presumed long duration is growth as a strategy doesn't have as much duration to it as the representation of growth that you tend to think of, kind of an Amazon-like company that just grows and grows and grows forever. One of the issues with growth as a strategy is, in general, growth is a feature of the young. It is relatively young companies that do most of the growing. Mature companies don't tend to grow that much. Those that do become the largest companies on earth. So Apple and Microsoft and Google and Amazon are the exceptional growth companies that have managed to grow a lot longer than the average one does. But if you are buying growth as a strategy, the average company stays growth for somewhere between 3.5 and 5.5 years. So its duration as a growth company just isn't that long. And the problem with growth companies that seems to be growth companies is that is a painful process, right? They get significantly derated, and they have been derated at a time where people's expectations for the future have also gotten worse. So kind of your expected earnings have gone down, in the PE you are prepared to stick on those earnings have gone down as well. So I think people have a tendency to overestimate the actual duration of growth because they think of this company that's not going to be paying dividends for 10 or 15 years. And the reality is an awful lot of those companies you're going to start out with, you will have sold and regretted well before kind of that long duration kicks in. Now, that said, if you believe that interest rates are going to stay very low, and there are people who not only believe that, but believe that they are going to go even lower. The more you believe they are going to go even lower, the more you want to have a long duration way of betting on that. I guess from my perspective, with rates at the lowest we have ever seen in history, and a demonstrated lack of ability by the market or anybody else to forecast the future. The one thing we know is, man, we're really extreme. So I get nervous owning assets that are predicated on an assumption that that extreme thing is going to get more extreme or stay as extreme as it is. But if somebody said, look, I'm buying the S&P because I think it's going to deliver 3% real for the next 100 years, and I'm good with that, that's not crazy.
Well, actually, we've got a couple of questions here about catalysts. Do you see a catalyst that's going to take the S&P back to a more normal valuation? Do you see anything that a catalyst for value or international? There's caveats here. It's not your game, right? It's not.
Right. So I will say there's kind of a couple of layers of problems here. One is I can demonstrate that I suck at catalysts, right? I have a career of having been early. If I knew much about catalysts, my career would have looked different. However, as we've tried to look back at kind of really important turning points and kind of the bursting of bubbles through history, most of the time, even in retrospect, it's hard to know what the catalyst was. We don't know what the catalyst was for the breaking of the internet bubble in 2000. I mean, you know, we were all alive. A lot of us are old enough to have been there. I still don't know what the heck it was. And historians aren't telling us. We don't know what caused the market to break in 1929. We haven't the faintest idea what happened in 1987, even if that wasn't the bursting of a bubble. And we don't really know what it was that caused the Japan market to fall apart in 89. You know, the GFC is a little bit clearer depending on how you want to define what the start of it was. Obviously, the failure of Lehman Brothers was a big thing, but the market had come well off the highs well before that. So I'm not good at catalysts. I'm not sure a catalyst is truly necessary for things to change. But I'm going to come up with a couple of potential ones anyway. From the standpoint of markets going back down to historically more normal levels, the obvious thing that would trigger that from my perspective would be a situation where interest rates start moving back to those more normal levels. The obvious trigger of that would be inflation. Do I know we're going to get inflation from here? No. I don't know how anyone could be dead certain we won't get inflation from here. We are trying an experiment that has never been attempted before, right? We have huge fiscal stimulus that is being met and funded by huge monetary stimulus in a global fashion at a scale that's never been done. And in an environment where while economic activity has fallen in a very stark way, the lasting damage to the economy may simply not be there in the same way as it was in the GFC or other deep recessions. So, you know, I can paint a scenario where economies actually really do zoom ahead as we get this pandemic behind us, if please God we get this pandemic behind us, and we really do get an inflationary event. An obvious difference, though, and a reason why it's not at all certain is our economy is so dominated by services that even if we got significant inflation in the goods production portion of the economy, that wouldn't be enough. We need services prices to go up. Service prices going up basically occurs if wages go up. So in order to get inflation, we do need to see wages rise in a way that they haven't in quite a while. Now, again, we've got a Democratic administration and sort of Democratic control of all three of kind of the important pieces of policy making right now. So maybe that's going to be different. I'm by no means certain of it. I'll say a couple of other things. If we don't get that extraordinary boost of activity when COVID is behind us, the other thing that could cause the bloom to come off the rose would be if we get beyond the pandemic and we get back to a normal economy and people look around and they say, you know, a normal economy wasn't all that great to begin with. And we've just bid up everything, and now we got normal. So I could imagine that happening. The other thing that I think is truly going on, and you can absolutely take the other side of this with regard to whether this will impact the market as a whole. But I do think we've gotten, whether you believe that we have a bubble in the broad market, I think the evidence that we have bubble type activity going on in the growthy end of the market is very strong, right? I mean, the Gamestop stuff, the amount of speculative fervor that is going on today is extraordinary. This is not a normal market. This is a speculative bubble. And one of the things about those speculative bubbles is we haven't seen a situation where you get a speculative bubble and then it dies, but it kind of dies into a flat line of boring market.
Peters out. Yeah.
Yeah. Speculative bubbles are kind of these natural Ponzi type situations where you need an ever-growing number of participants. You need ever greater dollars to be pushing this stuff higher. And in the absence of that, they tend to collapse. So I think that growth end of things will collapse. I don't know exactly how long it's going to take, but I certainly think it is much more likely to be measured in months than years, just because it's easy to underestimate just how much money has been sucked into this already. Even $5 trillion might not be enough to keep the ball rolling at the growthy end of things for all that much longer.
Fair enough. I've got a whole bunch of questions here, and we're running low on time. We may go a little over if that's okay with you, Ben, if you've got 2 minutes, because there's a lot to cover here. We've got questions about ESG in general and about how you think about it in terms of EM valuation in particular, since EM stocks tend to score lower on ESG screens, et cetera. Can you just talk a little bit about your thinking about ESG and how it affects your valuations, if at all, and so on?
Yeah, so there's, I mean, ESG is a complicated issue. And I think the assumption that kind of all EM companies score poorly relative to all developed companies on this is now an oversimplification and is no longer true. But the average EM company scores worse, one, because of the sectoral composition. They tend to be more on the goods production side of things, and goods production has sort of environmental consequences. Governance isn't, uniformly great, although again, it isn't uniformly great in the developed world either. What I would say, the way I generally think about ESG is it is a statement about quality of the investment that you're making. And I think it makes sense to be willing to pay a premium for high quality businesses and to want a discount for low quality businesses. But if they are trading at that discount, they can be wonderful investments. And when we're coming up with our estimate of fair value for emerging, there's kind of two layers of that. We demand that EM trade at a lower PE than the developed world because of its lower quality. That's even after we've thrown out effectively the state-owned enterprises, which have their own governance problems, which mean, to my mind, not you should never own an SOE. It is more that, yeah, you should be getting paid for taking that governance risk. So they should trade cheap even relative to broad EM. But even apart from the fact that we demand that they trade at a cheaper PE, we also effectively demand that they trade cheaper relative to assets and sales even beyond that. So our idea of the fair price to sales of EM is a lot lower than the fair price to sales of the S&P. And even with that, EM looks a lot cheaper. Now, it looks less cheaper than it did 6 months ago, because this has been a heck of a 6 months for emerging markets. A lot of that has been concentrated in a couple of markets, most notably China, and in particular on the growth end of things. So I think EM value is an awful lot cheaper than broad EM. And my fondness for EM is really about a fondness for EM value. But as a valuation sensitive investor, ESG matters. I think of it as very much a kind of quality. And I don't believe you should just generically own a portfolio of high quality companies. I think you should come up with a price you're prepared to pay for a company, given its quality characteristics. And when it's trading cheap to that, cool. And when it's expensive to that, don't own it.
Fair enough. How do you think about intangibles when you look at this? Because this whole thing with the service economy, it kind of jives with this. How do you think about intangibles in terms of valuations?
Yeah, so I think that ignoring intangibles is going to leave you unable to measure the value of companies. And I don't think it's impossible to measure intangibles. I think, part of the issue with intangibles is it is legitimately true that the accounting treatment has not kept up with the changing way that companies actually do their investing. And so intangibles matter because the kinds of investments that lead to intangibles are truly investments and ought to be capitalized and ought to be really thought of as on companies' balance sheets. What we have tried to do in our in the equity portion of GMO is we have gone through and we have tried to correct the balance sheet and income statement of every company for kind of the proper accounting treatment of intangible investment over time. And we think with that, it is possible to both understand that, a company like Amazon, it is not only the case that Amazon has an awful lot more value than you can see in its book value, which is irrelevant and small, but it has been a consistently very profitable company, despite the fact that it hasn't looked profitable on GAAP earnings very much. So I think you need to correct that stuff in order to be able to value companies. I don't think it's impossible to do. I mean, it's impossible to do perfectly, but everything is impossible to do perfectly. And if you are going to try to understand the value of companies, you damn well better be trying to understand the value of the intangible assets.
Okay. Yeah, no, I totally agree. It's really important to address this. A couple more questions. Real quick, timber. Right, you guys were timber fans for years. Is there value in the area? How does it coincide with?
Honestly, I'm not as close to it as I used to be. We did have a forestry business that we kind of spun out to a different home. We were not a great home for that. That was kind of a private equity type business. And one of the things about private equity businesses is you need to raise a new fund whenever it's time. And you have to do that irrespective of whether the pricing of the asset is good or bad at the time. We don't do a good job as a firm of getting people excited about investing in an asset when its pricing is expensive relative to history. So we weren't great underlying sponsors for them. But as a result of the fact that they're no longer down the hall, I don't have as close a lens on forestry as I used to. Certainly it has done well over the last 20, 25 years, but a lot of that has been bidding down the required rate of return of forest as an asset. So the potential return going forward is certainly not what it was 20 or 25 years ago. Now, that can be said of a lot of assets. 20 years ago gets a little weird because of the stock market bubble, but I think it makes sense as a long-term asset. It has some lovely tax features for taxable investors as well, but the pricing has gone up a lot.
Okay, here's a good one. Can growth stocks mean revert especially the large cap tech companies, without taking down the entire market?
Well, so what I talked about, one of the problems of the style indices as a way of thinking about either growth or value. One of the issues with the growth style indices today is they have much less diversification than you would think, right? Because the weight of the fangs in them is so big. Apple is whatever, 11%, and I'm probably off by a couple of months, and Tesla's come in, so I don't know, maybe it's 10.
Directionally,
It is a huge piece of the index. In aggregate, they're like 40% of the index. If they go down, the other 60% isn't going to be able to make up for that. The other kind of weird thing is they have a potential problem, which is very different from the rest of the growth universe. These companies have been exceptional growth stocks, primarily because they have continued growing at sizes and ages that normal companies would have long since stopped to be growth stocks. Cool, wonderful. They have wonderful franchises and barriers to entry and network effects. I mean, they're just awesome money-making machines. The bad news is they're basically all monopolists of one kind or another, and potentially vulnerable to a more activist antitrust. The US, has spent a generation thinking of antitrust in a very narrow way about consumer harm. We're kind of slowly understanding that there is different kinds of harm to the economy and society from dominant companies, even if it doesn't obviously lead to higher prices for consumers. So I would say the thing about the giants is, in general, their valuations aren't stupid. Now, if we are declaring Tesla to be one of the giants, and on a market cap basis, it sure as heck is, okay, its valuation is stupid. But if you think about Apple and Microsoft and Amazon and Google and Facebook, their valuations aren't stupid. Maybe they're expensive, right? Apple 4 years ago traded at 13 times earnings. It's now trading at 39 times earnings. That's 3 times as high. It had more growth ahead of it then than it does now. So it is more expensive than it used to be, but it's absolutely possible that it can grow enough to justify its valuation. And that's kind of true of all of these guys. The issue is, are they going to be stopped by policy? And I think that is a much bigger threat than it used to be. And if you buy the value index, or indeed, sorry, not the value index, the growth index, or indeed the S&P 500, you're pretty vulnerable to that.
Well, do you think that breaking them up might actually increase the value of the pieces?
It's possible. And it may be the case that breaking them up is not the right way to fix the problem. There may be other limitations on their businesses and what they do. That is a better remedy than breaking them up. But certainly they grew together, right? I mean, Facebook bought Instagram and WhatsApp for a reason. And maybe the combination of all three of those would be worth more than Facebook. That would probably be true if somehow they are split apart but do not compete with each other, which would suggest that they may have become separate, official companies, but are still operating in conjunction with each other. The basic issue with each of these companies is they have access to information and access to kind of their customer base in a way that nobody else can match. That's probably not net good for society or the economy. Exactly how you fix it and whether legally we can come up with without passing new laws about it, whether we can come up with a good way to fix it, I don't know. And I am neither saying, by all means, don't buy the FANGs, right, that they're crazy to buy, or that they are absolutely going to get taken down a whole bunch of pegs. But it is a risk, and it's a risk that you should understand exists if you buy the cap-weighted incarnation of growth. And those companies could have a problem that exists even if your sort of generic thinking about software eating the world or what have you plays out.
Okay, I mean that all makes sense to me too. I think it's pretty. I mean, it's hard to say what's going to happen to these giant companies because something else could come along and disrupt them in some way or another that we haven't even thought of yet. That's the other part of it, right? Which is, you know, we talk about tech disruption a lot at the university, and I think that kind of plays into that. I think maybe I'll ask just one or two more. You still have time, right, Ben?
Yeah.
Excellent. Do you have any thoughts on the direct lending and private equity spaces? You feel like there's, in terms of, that's all it says. What do you think about direct lending and private equity? I think it's about, you know, valuations, about dollars chasing deals, things like that.
Yeah. I think there's often a misunderstanding. Let's start with private equity. There tends to be a misunderstanding to where the returns come from in private equity. People have a tendency to make the following argument. Private equity investments are illiquid. People do not like illiquidity. Therefore, private equity will have a higher return because of the liquidity give up. I don't think that is a fair way to think about it, even if it is the case that investors love liquidity. And the reason why is private equity, at least in the LBO sense, is purely voluntary illiquidity, right? You took a company, it was public, you took it private, you are then going to take it public again. So at the start and the end, it is public and got no illiquidity premium. In the middle, it was illiquid by your choice. Now, you did that in aid of something. You believed you could, if you had full control of the company, you could fix the way it was managed, or you could fix its balance sheet, or you could combine it with a bunch of other companies that you own to build a better company. It was in aid of something you thought you could do well. But the illiquidity is a means to an end. It is not something that you should directly get paid for. And as we think about private equity, the problem is, as it has gotten bigger and bigger relative to the size of the public equity market, you know, insofar as these guys were exploiting an ability to find undervalued companies, that's harder when you're big, and that's also harder when there's a whole bunch of you trying to do the same thing. If it is that you do a better job of managing companies, that's harder when the world has seen the playbook and knows the playbook. As you are trying to put more and more money to work, even if you were very good at this and you weren't facing more competition, it's just harder to do something at 10 times the size that you were doing it earlier. So there are quite good reasons to believe that the past history of private equity might not be a good guide to the future. There's the other fascinating thing about the history of private equity, which is you can't find two people who actually agree on what the historic returns have been to private equity. So I don't even know how good private equity has been in general. The way I think about private equity is, it is unquestionably the case that the scope for value added, if you are really good, is wider in private equity than it is in kind of public equity investing. And if you think you are really good at finding extraordinary managers, it's a pretty good place to spend your time and effort. Now, you are paying them as if you think they are brilliant, right? I mean, you're paying them something like 2 in 20, so they damn well better be brilliant because they're sucking up a lot of the return. But if you think you're really good at it, that makes a lot of sense. The bad news is if you're not really good at it, the one thing you know you're doing is you're paying an awful lot more in fees. So I think that's true of private equity. Direct lending is a little bit different because there's a better case to be made that there's an illiquidity premium that you are directly going after. That's kind of similar to venture capital, assuming these companies were too small to be public. There might be a reason why raising money in that form could have a higher embedded return because they don't have the option of going to the public markets. But again, there's a lot of competition there. And the biggest reason I think why people love direct lending is because of the failure of marking this stuff to market. So
similar for private equity in some ways, right?
Yeah. So it's, I'd like to say, please don't buy it for that reason. But we started out this discussion on career risk, and it may be very good for your career risk to own something that doesn't fully mark to market, and especially if your peer group does, you would be ill-advised not to.
As you know, our peer group is very fond of that. So I have two more topics I want to cover real quick. First of all, I've got a couple questions on passive money. With so much passive money moving into markets, is there such a time that valuations don't matter, or is that what's driving it? Can passive and active funds coexist? I've seen other writings about this, about passive money, people just blindly putting their money into the stock market every month is what's driving it up, and it's going to keep doing that forever or until we're all dead.
Yeah, I mean, it certainly hasn't been the passive money that has been driving things over the past year or so. There has been way too much kind of stock-specific stuff going on, and way too much narrative-driven investing to believe that it is that passive is driving it. And after all, I think recently we've hit some of the lowest levels of cross-sectional correlation in the stock market that we've ever seen. Passive should cause that to go up. What we're seeing now is very low levels. The more of the market that is passive, the better the world is for active investors. Because one thing passive investors are, they always demand liquidity. Because they have no opinion on the value of anything, they just buy it. They always need liquidity. They need liquidity when they buy and when they sell. And the only people they can get that from are the active managers. So if you had a sufficient amount of the market being passive, active managers could actually win as a group. Unfortunately, that requires an awful lot of the market to be passive. And I don't think we're particularly close to being there. But I'm all in favor of passive investing on two grounds. One is it's never a stupid idea, particularly if you don't think you are better than average at finding better than average investors. Passive isn't a bad idea. But the other is the more money that is passive, the more mispricings there are likely to be in the market. And active investors need mispricing.
That makes sense. So now I've had a question about Bitcoin. That was on our list. Can you just give your thoughts on cryptocurrencies and Bitcoin real quick?
Yeah, the quick version. It is important to at least recognize the fact that buying Bitcoin, or indeed mining Bitcoin, is not an investment in a normal sense. The way I think about investing is using capital to perform some kind of economic service that someone rational on the other side would be willing to pay you for doing. So that includes lending money, that includes giving money to companies, that includes buying stocks from other people because stocks are correlated with their other income, and so you're taking risk off their hands. The thing about Bitcoin and other related cryptocurrencies is holding them is not actually doing anything. You're not helping anyone by doing it. And there's obviously no cash flows associated with it. So it isn't investing. Now, that's not the worst thing in the world. You can have speculative activities. And Bitcoin has the potential to be the speculative winner, right? Gold was a speculative winner. There's no particular reason why gold has any value, but we all agree it's got some value, so it's got some value. Bitcoin needs that more than gold, because gold does have some use. It's pretty. It doesn't, it doesn't tarnish. It's malleable and ductile and not a bad conductor. I mean, there's stuff you can do with it. There is nothing you can do with Bitcoin other than hope somebody else is prepared to buy it. I mean, literally, right? It has no other use except to the extent that other people decide it has value. That does not mean its value is inherently zero, but its intrinsic value is. So I also think Bitcoin is, insofar as it was originally designed to be an effective way of doing transactions online, it has proved to be a dismal failure in that because the transaction costs too much. It was supposed to be this frictionless way of doing things. Nope, it's not frictionless. It might be a lovely store of value. The problem with it as a store of value is it's pretty volatile. And my ideal store of value would be stable. So it might wind up winning. And the thing about something that has no intrinsic value is you cannot inherently say $32,000 is a crazy value for it. That is no more or less crazy than $32, $3,200, or $32 million. They're all equally, who knows? But it is important to recognize this is not an investment, it's a speculation. And my view is if you really are concentrating on making money over the long term, the thing you should start off by trying to do is invest.
Okay, no, that all makes sense to me too. I go back and forth on crypto and Bitcoin, but I think we're going to cut it there. We've run over on time. Ben, thanks. I know we covered a lot of ground today, and I apologize to people whose questions I couldn't get to. There was obviously way more questions than there were time. So now for the ending. Thanks to Ben for joining us today, along with everyone who attended the event. At the end of the event, you'll see a notice to complete a survey about today's event. Your feedback helps the society when planning future events, and your feedback is very much appreciated. If you have any questions about today's event, please contact CFA Society Chicago office at info@cfachicago.org. Thanks, everybody. Thanks, Ben. So
Thanks, Harry. This was fun.
Yeah, it was great. Thanks again.